Hey guys, coming at you with another weekend update video. It is Sunday, June 21st. It's about 9:50 in the morning, and just kind of getting my thoughts together for what my plan is for this coming trading week starting tomorrow. And if you remember from my prior videos this past week, I am mostly cash, except I currently am still holding 100 shares of Micron at a cost basis of $49.50 a share. So of my portfolio, I have $4,950 that are locked up essentially in Micron shares. Now, if you watched my video from this past Friday, you know I was trying to sell out of those shares for some profit. If Micron opens up above $49.50 on Monday morning, I'm going to sell those off. Just because I've been reading a lot of news this week and this weekend and seeing a lot of charts and graphs, and obviously it's just very all doom and gloom. And I'll show you some of the graphs I was looking at in a while. But, you know, I might not even open up any positions, new positions this week, because I want to be cash right now because I'm very concerned. And this is all my opinion, obviously, and not financial advice. But I'm just very concerned that we are peaking out again, or this is the top before another dip. So I may just sit out this week altogether if I can get 100% cash. Or if I don't want to sit out completely all week, maybe I'll let Monday, maybe Tuesday, maybe Wednesday play out, and then maybe make a play on Friday for a Friday expiration on Wednesday or Thursday, let's say. That way I don't have a whole week's worth of stock trading for these stocks to move against me. Because if I open up new puts, my concern is that the strikes are going to get tested, or I'm going to get assigned shares if the market really dips. So looking at the big board here, this is how we ended Friday. So a mixture of red and green on the board, but in general, a sideways day. And really, last Wednesday, Thursday, and Friday were all kind of sideways days. You know, stocks were up and down depending on which sector you were in, but tech kind of traded sideways or was down just a little bit those 3 days as well. So, you know, I was really hoping for a Micron pop later in the week last week. It didn't happen. So, like I said, I don't want to mess around, because if I can get out of my Micron shares, and if I did want to open up another position on Micron, well, I could open up a cash secured put on Micron at a lower strike price than $49.50 right now. If we just take a quick look at where Micron is right now. So Micron's at 50.75 currently. You know, one interesting thing is I'll have to see what the market is doing this evening during after hours trading. But just keep in mind that after hours trading and pre-market trading is not always 100% indicative of what's going to happen next trading day. I've been kind of keeping an eye on after hours pricing, and you know, there's been times where in the evening the market's been red, and then it's been red early pre-market, and then it goes green right before the market opens, or vice versa. So it's just kind of honestly, I just do it out of habit and just out of curiosity, but I don't put a lot of weight into it, because I remember last Friday morning, I believe the market pre-market was up about 1.5%. So a good amount. So that also added to my belief that the market was going to be green, and so that's why I held on to my stock, trying to get more stock appreciation as the day went on. But as you can see, this Micron graph, the exact opposite happened. It opened up and shot up green, and then it just bled off all day long. I mean, it did close in the green, but not up 1.5% like the overall market was pre-market. But the whole market did that. It opened up high, and then it bled off all day long. So that's why I said you can't, you know, rely on pre-market information as an indicator of what the day is going to do overall. But, you know, just as an example, if I were to get out of my position on Micron and I wanted to open up another put at a roughly 0.4% return on my risk, and that's like the minimum I like to trade, I could probably get in at maybe $46. So let's just see. If I do $18 divided by a collateral of 4,600, that is, yeah, almost, right? 0.39. So I could do 46.50, and that would definitely get me to above 0.4%. But, you know, like I said, this, if I do get assigned shares, it'd be $3 less than what I'm currently assigned on. So that's why I'm saying I definitely want to get out of Micron shares as early as possible this morning, or Monday morning, I should say, just because I'm very concerned about what the market is going to do. And then, you know, I don't have to open up another position on Micron. I could go back to my best friend AMD here, but AMD is also trading in the kind of mid 450s. So if I wanted to open up a position on AMD, I could probably get in at I would probably have to get it at 50, I'm assuming, if I wanted a 0.4% return. So let's just see, $29 divided by 5,000 in collateral. Oh, that's a little bit higher than 0.4, so I could probably get in at 49. That's 0.58. So I wonder if this, that's probably the 49 strike that'll get me the 0.4. 4,900 in collateral. Yeah, so I could get in sub 50. And if you've seen my previous videos from the prior weeks, I've never owned AMD less than 50. I think my cost basis before have been in like the $51 range. So that would be nice again. Also, if I do get assigned AMD shares, to get in sub $50. But that's just the other thing. And then Disney, I know we've been talking a little bit about it and potentially getting a play on it, but Disney did not do well at all Friday. In fact, Disney dipped a lot. I mean, Disney was down 2.5%, or actually a little bit more than 2.5% on the day. Even though it opened up green, it bled off pretty hard all day long. And I think part of the reason is because there's a lot of concern right now, because Disney is set to open its theme parks, I believe, in 4 weeks or so now. And if you've been following the news, Florida's getting hit really hard right now with another resurgence of the coronavirus. So there's kind of rumor that Disney's probably going to delay their opening. And obviously that's going to be really bad news. And so the stock price may be reflecting that right now. And that's why it might be going down. So I think I'm going to hold off on opening any positions on Disney, because it might bleed off even more if bad news does come out. But the good news is, if that does happen, again, I could get in at a lower strike price if I do decide to sell a put on Disney. But just a heads up. I mean, you could make the argument that Disney is much more than its theme parks, right? It has Disney Plus, it owns ESPN. I believe it owns about 7% of DraftKings, the sports gambling website that's been blowing up lately. So it does make money in other areas, but you know, sometimes people just think that Disney's only in theme parks, and that might cause the stock to drop if people start selling off in panic. But just to keep an eye on that. And then lastly, IWM. So this has been sort of sideways for the past week. Yeah, I mean, this is the weekly graph. So it had a run up June 15th, and then 16, 17, 18, 19, like Tuesday through Friday, it just traded pretty much sideways, which is great if you were Theta Gang like we are, and if you sold a put, your puts are probably secure because time decay probably just ate away at it. And I did have a put at 135.50 on IWM, which expired worthless because it was just trading sideways. So I was able to make $56 last week just by selling that one put. But again, because of how tenuous the market is, in my opinion, right now, I'm probably going to hold off on opening any trades on IWM, because of all the indices, like between IWM and SPY and QQQ, IWM is the most volatile, meaning it fluctuates up and down more than the others, and that's reflected in its higher option premiums. So the more volatile an option is, i.e. the more risk you're taking on, the more reward you're going to get. That's i.e. you know, the higher the option premiums are. But we'll have to keep an eye on IWM. If you've seen my other videos, you know that Jerome Powell owns a lot of IWM shares. And IWM, these iShares Russell 2000 ETF, is actually a BlackRock ETF, and BlackRock is the company that the Fed has kind of tasked to do these, this printing money into the economy. So BlackRock is the one that's actually buying all these ETFs on behalf of the Fed, essentially. At least that's my understanding. So that's why I feel a little bit better about the iShares Russell 2000, the IWM, as opposed to other Russell 2000 ETFs. But again, just my opinion, not financial advice. If we want to take a look at the stock graphs for these, you can see that this is the graph for AMD. And again, it's just been trading sideways for the past couple of days. The one thing I have noticed though is that, you know, in this period, AMD traded sideways and then it rocketed up. So I'm wondering if AMD is also just building up momentum and it's going to rocket up again. But I guess there's a possibility that it could also dip down. But it's kind of been straddling this 78.6% Fibonacci level here. So we'll have to see what AMD wants to do, whether it wants to trade in the blue area or the gray area. So it's actually funny. So as I was just speaking, I just saw this stock twit. It says AMD looking like it's breaking out, good for semiconductors like Nvidia and AMD. You know, again, these are just people's opinions that are on stock twits. So, which is essentially, if you're not familiar with stock twits, it's Twitter, but just for stock market basically. So hence stock twits. There's just people tweeting about stock tips and ideas and what they're seeing in technical analysis. But again, these are, yes, some of these may be analysts or professional traders, but I would say the vast majority of these are probably just regular people like me and you. So it's all opinion based, right? Nobody knows anything for certainty. So some people on this, you have to be careful because they're just pumping their own stock. Like this guy, he might own, or girl, this guy or girl may own shares of AMD. And so they may just be trying to pump the stock up so that they can sell it off or something like that. So you got to be wary about that. But taking a look at the graph for Micron now. So kind of similar scenario. I've been trading sideways. I mean, this was Friday where it had a big pop up and then it came right back down and actually closed lower than where it popped up from. So interesting to see. You know, if we look at the Bollinger Bands, it is towards the bottom of the Bollinger Band. So that would make me think that it wants to kind of run up a little bit. But, you know, again, this is just technical analysis. There's no TA that is 100% accurate. I mean, some people believe that all TA is just kind of like reading tea leaves. So, you know, who knows? And they do have a point because people make the argument that if technical analysis was reliable, then we'd all be rich, which I agree with that statement. So you know, sometimes I use technical analysis, I think, just to make myself feel better. It's just like a mental thing. But, you know, let's see what the market does on Monday. And again, if we want to take a look at Disney, see we had this big drawdown on Disney the past 2 days, June 18th and 19th, Thursday and Friday. And, you know, it's going to be curious to see what happens. If we look at the RSI curve, Disney is very close to the oversold category. So based on this technical analysis, you'd think that Disney's going to kind of rebound a little bit. So we'll have to see. But looking back historically, looks like Disney's kind of been trading in this light green area for a long time. Then it had a pop up into this dark green, which then popped up even higher to this teal area. But I wonder if Disney is ultimately going to want to be going back to this kind of light or shaded gray area. So we'll have to see what the market does on Disney. But if that happens, I mean, this area is about $98 to $108. So that might be a good, if you're long on Disney and you don't think that we're going to dip again, that would be a really good entry point, I think, because Disney was already back up to like high 120s just very recently. So have to check that out. Keep an eye on it. IWM, again, traded sideways, but slowly kind of actually went sideways to a little bit down, right, for the past couple of days. But right now it's straddling that 61.8% Fibonacci level. So we'll have to see whether it wants to bounce up or kind of trade now in this teal area, which is a low of 133. So, you know, we'll have to keep an eye on that and see what IWM does. But again, I think in general, I'm going to try and be 100% cash this week and just kind of let the market play out and feel itself out. One of the questions I've gotten, or at least one of the comments that somebody posted in one of my recent videos, is that they trade stocks that are only in the S&P 500. And that was very interesting to me because that's definitely a strategy to think about. Because if you watch my previous video on how I pick stocks to trade options on, one of the biggest factors was liquidity or volume. And the S&P 500 is a list of the 500 largest companies by market cap on the stock market. And so, you know, one of the other things I like to look at when I'm picking options is, do I want to hold that stock long term? Meaning, is that a reliable, stable company? So usually, you know, the largest companies on the market are going to be more reliable, right? So I went out to see and find a list of the 500 companies on the S&P 500 and to see if any of those interested me in terms of maybe adding them onto my watch list. And so actually, if you go back to this website I've showed you before, barchart.com, if you click on stocks here on the top left, and then if you scroll down to where it says indices here on the left side, you can actually click on the different indices. Like here they have the Russell as well. But if you click on S&P indices, you can see there's the S&P 100, 4, 5, and 600. So the top 100, 4, 5, and 600 market cap weighted, I should say, stocks on the market. And you can actually see a little bit of data on them, meaning their 5-year or 5-day, 20-day, 50-day averages and such. And then if you keep scrolling down, you can see a list of all of those 500 companies. And then you can actually sort by their trade price, percent change, their volume. So actually right now, Bank of America was the most highly traded stock in the S&P 500. Ford was second. United was third. American, GE, Norwegian, AT&T, and the list goes on. AMD was actually right up there. I mean, AMD had a volume of 52.8 million. So you can actually, what I was planning on doing was going through this list and then seeing which stocks that I like, and then double checking their 5-year graphs and making sure their option volume was good too. And I'll give you an example. So from this list, I found Johnson & Johnson. And then what I did was I went to J&J's, that's the ticker symbol for Johnson & Johnson, because I thought, that would be a good, there's like a pharma / healthcare company. And I thought that would be great to add that to my watch list, because I really don't have any pharma stocks or kind of healthcare related stocks on my watch list in terms of diversification. And I know Johnson & Johnson, they've been around forever. So I did what I usually do. I checked the 5-year graph, and it's what I like to see. It's been going steadily up over time. So everything is looking good so far. And then I went to the options chain just to see how the options are. And I just said, let me just check the put at the money, which would be like 143. You can see the volume is really low. It's only 118 and the open interest is 118. And to further support that, the bid-ask spread is pretty wide, between 137 and 171. So it's what? $1.71 minus $1.37. So the bid-ask spread is 34 cents wide. It's not the widest I've ever seen, so it's not the worst. But my concern is with such a low volume in open interest, it's going to be a hard time to get a good fill. And also, if you want to close out the position for some reason, hard time to get out of it too. So although I liked J&J as a company, it seems like it's not a very popular stock in terms of options trading. So you can do that. I would suggest just going through this list and, not financial advice, but just go through this list, see what stocks you like and look into them. I mean, here's Walt Disney here. Walt Disney was also pretty popular in terms of trading. But as we can see, if we go to Disney in terms of its options chain, we can see what the volume is. So let's just say Disney. We'll look at, again, selling a put at the money, just like we did. And if we go to 114, see the volume is, almost 10 times that, right? It's 1600 compared to the 118. Open interest is also 750. Bid-ask spread is also a little bit wide, but it's really the volume in the open interest that concerns me with J&J right now. Let's just see. Well, it should be 217. So it's 50 cents, right? So it's not quite as bad. Actually, it is worse, to be honest with you, than J&J, but the volume in the open interest is better. So that's interesting. I mean, let me just see if we look. Yeah, so some of these are going to fluctuate, right? Because if we go down a little bit further, this bid-ask spread is only 25 cents apart with a good volume and good open interest. So maybe for whatever reason, that 114 is just not a popular strike. But anyway, so you can play around with this. And you can actually go, if you don't want to trade the S&P 500 stocks, I mean, you can also trade or sort these by price, right? Because a lot of these are going to be more expensive. So like, Amazon is like 2,600, but if you don't have that much capital, you can scroll down and, go to like the third page and find stocks that are, less than $100 or $20, $30 or so, because those companies are here too. If we go all the way to the end, I mean, the cheapest company right now is actually, well, the second cheapest is Ford on the S&P 500. It's only trading at $6.23. GE is $7.15, but these are some of the largest companies in terms of market cap on the index. And you can do the same thing for the NASDAQ, for the Russell. So here's the Russell, and again, they have the Russell 1000, 2000, and 3000. So either the 1000, 2 or 3000 small to mid cap companies. And you can see Apple is actually in the Russell 1000, which is actually, that's interesting. Well, I'm not sure why Apple is there. Let's just sort by. That's very interesting. I'm not sure why Apple and these other companies are again in the Russell 1000, because I thought these were only for small to mid cap companies. I'll have to look into that. If somebody knows the answer to that, leave it in the comments below. But you can do the same thing with these indices, or if you want to trade the NASDAQ 100, you can see what stocks are in the NASDAQ 100 as well. So just another way to kind of do some research and figure out what stocks you may want to add to your watch list or trade options on in the future. But let's take a look at some of the charts that I was seeing over the weekend that are kind of putting me off to the market right now. So here's one graph I found on Twitter that is talking about the new reported cases of the coronavirus over the past, few months. And you can see we obviously trended up around March, April, and then, we were slowly coming down, but now the 7-day average is creeping back up again. So as of June 19th, there were 31,630 reported cases on that day. So again, we seem to be trending back up, which depending on how you want to look at it, is either we're not out of the first wave yet, or we are out of the first wave and this is the beginning of the second wave. So, that's what I'm concerned about, because if people start panicking again and panic selling, then it might cause the market to drop. And the other thing is, so based on what I've read, the coronavirus has a 7 to 14 day incubation period. So my understanding is that means that if you get infected, you won't show symptoms for 1 to 2 weeks. So, there are events going on such as the riots and the Trump rally that just happened this weekend, where large groups of people are getting together and, states are opening up. And so, it might take a week or two before we see the after effects of people potentially spreading more virus and making this number go up even more. Here's another chart I found. This is showing the amount of debt. Basically, it says commercial and industrial loans across all commercial banks. So you can see the amount of debt has been going up and up and up over time. This is probably around the time, or close to the time. Actually, this spike up is probably close to the time of the Great Recession back in 08, 09. And then you can see that we kind of dip back down, and we've been slowly, while we've been in a bull market, been going up and up and up and up. But you can see this past, probably a few months, we've had a big spike up. So banks are taking on, how I'm interpreting this graph is that banks are taking on an exceedingly large amount of commercial and industrial debt. So my question then is, what happens if those companies that got loaned money from the banks go bankrupt and cannot pay back their bank loans? That's going to hurt the banks in the financial sector, right? Because now they've lent out money and they're not making any money from their loans. So that's why also I'm very hesitant to play financial sector stocks or banking stocks right now, because I think at some point, in my opinion, and again, not financial advice, the shoe is going to drop and the banking industry is going to get hit really hard. But again, that's just my opinion. So here's the graph that really scared me this weekend. And this is showing the PE ratio of the NASDAQ 100/S&P 500 ratio, and then comparing it to the 14-month RSI. So if we take a look, this green line here represents the tech bubble around 2000. So you can see that the peak was, a little bit above 3 here. And then we had that big kind of market crash right after that bubble popped. And so we've been kind of going up and down in terms of the RSI. But again, also that RSI was in the overbought section, right? Very high, almost in the, probably 85 to 90 range. So this is us right now. We're very close to the high near the tech bubble pop, but also this NASDAQ 100 to S&P 500 ratio is actually higher than it was when the tech bubble popped. So, I'm a bit of a bear, or I don't know if I'm a bear, but I'm a realist in my opinion. And I don't think the data lies, right? History is going to repeat itself. At least that's my thought process, or my working thesis. And what I think is going to happen is I think we're going to have another gigantic downturn at some point. I think we're in a bubble, and at some point this is going to pop again. So yet another reason why I want to be cash right now. And I might be cash for the next week or 2 weeks or maybe even month, because if this happens again, and you can see, this is probably around the year 2000 when we peaked. We didn't bottom out for, let's say 2001. We came up a little bit, then we retested the lows again like in 2002. So it took a good, probably 1 to 2 years from top to bottom till we started recovering again. Now, granted, this is the RSI, mind you. This is not the graph, but the NASDAQ 100 S&P 500 ratio kind of reflects that as well, where we peaked out, we dipped, kind of made a rally back, we dipped again. So again, this is like 2002, 2003, looking at this time chart. So, we were dipping for a good, maybe 1 to 2 years. So I really don't want to be bag holding stocks for 2 years. That's a long time. I would much rather be all cash and then dollar cost average into stocks on the way down and keep lowering my cost basis until we get to the bottom and then rally back up. That's just my kind of long-term goal. But that's why that I'm very scared about the market right now, and I'm trying to be 100% cash as quickly as possible. Because yes, if you do get caught bag holding, you can keep selling covered calls on the way down, but that's somewhat risky, because what if your shares get called away? Then you have to buy your option back to close it. It might take a little bit of a loss. But that being said, if I only own 100 shares, let's say, of a stock, and I sell weekly covered calls, I'm getting about $100 a week at most, probably. If I buy AMD, if we just go back to, let's just say AMD. Let's just say I get caught bag holding AMD, which I hope I don't. But let's just say, I'm bag holding AMD, and I sell covered calls that are, right now it's at $54. But let's say AMD drops to 50, right? Now I have to sell 54 strike calls. Well, right now that's 1, 2, 3, 4 strikes away. So 1, 2, 3, 4. So that would be roughly worth $50, right? And then let's say the next week AMD drops to $45. Well, selling a $54 covered call is going to net me like no money. So I'm going to have to be a little bit risky and sell $50 covered calls, hoping that AMD keeps going down and that this strike is not tested. Well, then again, that's about 4 strikes away, so I'll collect another $50. So I'm going to collect, $50 every week while watching AMD just tank and my stock value tank. So at that point, my options are either continue doing that for maybe a year or two and just keep making a little bit of money, because it's better than making no money and just watching your stock appreciation go down, down, down. Or I could just cut my losses and just sell off my shares for a couple $100 worth of loss and, live to fight another day. So just food for thought. I mean, that's kind of the thoughts that are running through my mind this weekend in terms of what my plan is for this week and maybe the coming weeks or months. But yeah, some of the stuff I've seen on Twitter in terms of the graphs and charts people are posting, obviously take everything with a grain of salt. But like I said, I don't think the data lies. So that's what I'm concerned about, is that we're going to repeat history. But we'll have to wait and see. As always, if you have any questions or comments, leave them below. And happy trading.